I'll start off the show with just a commentary, summary of what I saw happening to the stock market this week. What an amazing week, right? It's just the same thing. Basically, every time I look at things, I can't think of, how many more crazy scenarios we can have. And here we go with, this Ukraine situation. And so let's just kind of summarize what happened. Obviously last Thursday, Ukraine was invaded. The stock market here in the U.S. went up Thursday and Friday. This week it's been going up and down, but if you really look at it, it's sort of a sideways motion altogether for the week. Not a lot happening in terms of total rate of return, but that's still an accomplishment. If you look at what's happening in Europe, the indexes there are down 4 to 5% since since the invasion, sorry, and our stock market is actually up. So one of the questions that's been coming in, and I'll answer that here, is just, do we have exposure to the Russian stocks? And I've always had international exposure, including emerging markets exposure, which is what Russia, would fit into. Prior to the pandemic, we always had something there because I believe that's part of the overall diversification process that tends to work long term. But the international markets underperformed so dramatically during the pandemic and then subsequently as we had this recovery, and the US market was the place to be. So, for example, right now, we only have, if we look at everything we have, all of our holdings, all of our IRA type holdings, the trust type holdings, the stuff that's in our models, the stuff that used to be in our models that we haven't sold because of taxes, the things that people just brought in that they had before, we call legacy positions, all of that. We have 1% exposure to international stock and 1% exposure to international bonds, according to our BlackDiamond performance reporting system. So really, really, really low exposure to international stocks at all. And at the beginning of the year, I looked at the possibility of adding more international stocks just because finally we were starting to see some better performance out of the international stocks. But the thing that held me back was the fact that the US has higher inflation rates than most of the other developed countries in the world. And when that happens, that generally means we're going to raise our interest rates more, like the Federal Reserve is talking about doing. And when you do that, your treasury securities pay more, which makes them more, desirable worldwide. And US Treasury bonds are already desirable worldwide just because of situations like this. But generally speaking, that means that outside currencies are converted into dollars to buy these treasuries. That brings up the value of the dollar, which we have seen here. And then obviously what happens then is if you have international investments that are in a foreign currency, they're worth less because the dollar has come up. So that's what kept me out. And now all of a sudden we've got a situation that I'm really, really glad that we're not too exposed because of the scenario that the US has become the place to go, in my opinion. If you look at the treasury market, we've seen tremendous, gains in the treasury values. Means that people are buying treasuries as a safe haven. It's why we have 58% of our bond market exposure in Treasury and Treasury-related bonds. Again, it's a parachute. Those go up when the stock market's going down, or in this case, when Ukraine is invaded, when geopolitical situations are happening. And then obviously, we've got a scenario here where the stock market seems to be getting money internationally too. If I was looking around the world, I'd be looking at the U.S., even if I didn't live here, just because we don't have as much exposure to Russia. Only 7% of our oil comes from Russia, for example. 40% of Europe's gas needs come from Russia. 50% of Germany's comes from Russia. So they're going to have a lot harder time there dealing with this particular situation that's happening with the energy increase. So let me talk about what I think are the key criteria to look at here and to watch for as far as that goes. And really, it has to do with Russia itself and what's going on with these sanctions. So it's kind of some fascinating numbers that probably a lot of people don't really realize. The world's economy, total gross domestic product, is roughly $94 trillion. If you look at Russia's economy and their gross domestic product, it's roughly $1.7 trillion. That's only 2%. Russia is a really, really small economy. To put that in perspective, California's economy is $3.4 trillion. We're twice as big as Russia just in this state alone. And so, if you look at what can happen when that economy shuts down, it doesn't have massive economic impacts. The oil and gas, which I'll talk about in a minute, has more impact. But there is one possible situation we have to watch out for, and that's just sort of this scenario where somebody has something highly leveraged in Russia or in Russian assets that is now in trouble because of that high leverage. So back in 1998, when Russia defaulted on their treasury debt, that was a big surprise. And there was a big hedge fund called Long-Term Capital Management that had a massive holding in Russian treasuries that was highly leveraged. So when Russian treasuries went away, they owed that money. And of course, those people that had that money needed that money. If they didn't get it back, they were going to be selling other things, and those might be things that we own. In in the 2008 downturn, it was subprime loans that came down and were falling apart. And if you look at your portfolio at that time, you probably didn't have any subprime loans yet. Shortly thereafter, we all ended up with downturns in our accounts because people had to sell the stuff that we own in order to cover the losses that they were having in those other areas. So I think that's the biggest issue to watch for here with Russia. Small economy, it's going to be an amazing, devastating situation there. Some of the things I've never seen before. They've closed their stock market for the last 5 days, but some of the stocks are still trading. For example, on the London Stock Exchange, and they're down 90 to 99.8%. Some of these big stocks have turned into penny stocks or have been frozen completely. The London Stock Exchange has already frozen 36 different Russian companies from trading at all. Imagine if you owned shares in those companies and such. Really incredible. So what happens here from the standpoint of this contagion has a lot to do most of the times in some of these different sovereign funds or hedge funds and those types of things. I think the one thing that is probably a good thing that happened here was that this wasn't a big surprise. It was a surprise, but it wasn't like 98 when they defaulted on their debt, because that was a huge surprise. Nobody was really expecting that. There was a lot of warning about them invading Ukraine and what happens as far as that goes. So the secondary issues that we want to watch for here have to do with really, the energy prices. So energy is a big piece of inflation that's happening here in the U.S., for example. We had a 7.5%, increase in costs on an inflationary basis on the last report, year over year. In that report, energy went up 27%. So it's a big driver. It's a big piece of what's causing this inflation. So now we have oil and gas coming up even higher. So we're going to have more pressure on inflation. That creates more, potential for the Federal Reserve to get defensive there. Having said that, Russia only produces 10% of the world's energy. That means the other 90% of the producers can probably absorb that. It's just going to take some time. So we'll have this period of time where energy goes really high, and then hopefully these other countries and what have you and producers can start to absorb that differential, and that'll maybe stabilize the price of the gas and oil. We'll see what happens there. The other issue, of course, is interruptions to supply chains. For example, wheat that's coming out of Ukraine, and some of the palladium and what have you that's coming out of Russia that's used for semiconductors and et cetera, and other issues that are happening just in terms of the conflict itself. So as we've talked about several times before, supply chains are a big piece of what's going on with inflation also. So anything that disrupts those supply chains creates the potential for more inflation, which ultimately creates the potential for more Federal Reserve motion to the upside as far as that goes. So really interesting to see all of the different pieces that are playing through here and watch and find out what is going on. I definitely think this is a good time to buy American. We are in a perfect spot. I think there's going to be a lot of money moving into American stocks, mainly because when you look at this situation and you look at these companies here in America and you look at their exposure to Russia, and you see that there isn't a lot. And so when we start to report earnings, you won't see as much of a hit to earnings from that exposure. Maybe the scenario that happens with energy coming up can create some compression of profits. But so far, companies have been able to push along the increased prices to consumers, and they haven't seen a huge drop off in the demand for that, even at those higher prices. And that has a lot to do with the fact that here in America, we had a $36 trillion household net worth gain in total from the bottom of the pandemic to now. So people can afford, at least so far, these price increases, and that's maintaining this earnings increase that we're seeing that's happening. So I still think things are in play. I think all of this moves. I do think that the peak inflation that I was expecting to happen in March, that would have been reported in April, probably is pushed back a couple of months here because of this energy increase, plus this situation with the supply chain, and that might, have some impact on the second half, because I really feel like the second half is where we're going to see the big gains coming out of the market. I am very, very pleased that we have very small exposure to international, that we increased our exposure slightly to cash at the beginning of the year. That worked out very well, and that we're using this rebalancing methodology. And the last two rebalances that we did were at very low spikes, both on the 24th of January and the 24th of February. Those were really good times, at least looking back so far, to do some rebalancing and what have you. And again, the economy's hot, and the job numbers came out today. 676,000 new jobs created, expected to have 400,000. We just crushed that expectation. And so the job market is really healthy. People are coming back to work. We didn't see much in the way of wage growth, which I know if you want people to be paid more, you don't like. But from the standpoint of profits, wage growth can create a lot of inflationary problems. So that's unfortunately a good thing in this particular case in terms of what's going on with, the stock market as a whole. And the economy is really strong. We have no recession on the horizon here that I can see. There's possibilities and things that you could craft in your mind, and different people have, as to how we can get to recession, but it's not, it doesn't look like the most likely scenario to me. And that just means that the economy continues to grow, earnings continue to grow, even with what the Federal Reserve is going to do, even with what's happening here in Ukraine. And you're going to see the stock market eventually kind of come up during that period of time. And so when those scenarios are happening, when you get these fear situations, and the market drops based on that fear, rebalance, basically take advantage of that. And that's the strategy that's going to work here as far as that goes. We'll have to watch for these other contagion things. We'll have to watch for the possibility of recession. We switch strategies in those particular scenarios, get much more defensive, but that's not happening right yet. And we can't really predict, when it'll happen. We just have to react. I'm a big believer in kind of reactionary investing. Keep things, well diversified, have plenty of treasuries, do all these different types of things, but basically, make sure that, we're ready based on what can happen going forward, but react to what's happening right now, which is this is buying opportunities as far as I'm concerned. So anyway, that's what's going on right now. Very interesting time frame, really fascinating. I'm glad that you got a chance to, hear what I have to say. Look forward to talking to you again next week about it.